This is the earnings per share formula. But what is the earnings per share? And more specifically, if you look at two companies' earnings per share, how do you know when one is good and the other one's bad? We're gonna go through all of this step by step. To calculate a company's earnings per share, you need to first find the net income. This is a number that can be found in the company's income statement. The second item is the preferred dividends. If the company is paying this item is usually found in the income statement. The third item is the weighted average shares outstanding. This is an item that can also be found in the income statement. For public companies, you can get the financial statements online, or you can use a tool like Whitesheets to get all of the financial data all at once, like this. As you can see in this case, the company does not have any preferred dividends, but we can see the net income right here. This is roughly $96 billion. And then over here we have the weighted average shares outstanding, which is roughly $15 billion. For Apple, because the company doesn't have any preferred dividends, we can just simply take the $96 billion in net income and divide it by the $15 billion in shares outstanding, and that is gonna give us roughly 6.16 in the earnings per share. This means that if you were an investor in Apple, for every one share of Apple stock that you own and the company decided to give all of the profits away to the shareholders, you would be entitled to $6.16. So overall, EPS is a good measure of profitability for a particular stock. Now, there's three very powerful ways to analyze the EPS of a company, and we're gonna go through all of those one by one. The first is a historical EPS analysis. So if we go back to our income statement right here, we can see that the EPS is automatically calculated for many different years. What we wanna do is get an idea of whether this number has increased or decreased over time. So for that, what we can do is create a chart so that we could roughly visualize this information. So as you can see, this is the chart right here. And so we can see very positive growth in this case for Apple. The other thing that is very popular is that instead of looking at a chart, you can calculate the percentage change from one year to another. And for that, all you need to do is take the latest EPS minus the previous EPS and divide these numbers right here by the previous EPS. After this, you can turn this number into a percentage and then just drag it so that you can get this number calculated for the previous years. And this is very helpful to see if we have a positive EPS trend or not. The second and very powerful way to analyze the EPS of a company is to compare it with companies that are similar. So in this case, we have Apple and a whole bunch of other different similar stocks. So what we're gonna do is, using this formula, we're gonna get their EPS so that we can see how they compare to one another. As you can see in this case, Apple has a pretty good EPS. It is not the highest out of all these different companies, but it seems very good. Now, one thing to keep in mind is that the EPS is very much influenced by the number of shares outstanding. So perhaps Sony doesn't have as many shares outstanding as Apple. And this takes us to the third way to analyze the EPS of a company, which is valuation. So in this case, what we're gonna do is we're going to adjust this formula so that we can also get the stock price of all these different companies. And once you have the price just like this, what you can do is to compare the EPS with the price. This is what is known as the PE ratio. So if we take the price of Apple and divide it by the EPS, this gives us a good estimation of the price that we're paying for that particular stock. We can do this for all these different stocks right here. And what we can see right away is that Sony and LG are some of the cheapest companies. Apple seems like has a bit of a high PE ratio, but let me explain to you why. How the PE ratio works is that it compares the price that you pay for a particular stock or share of a stock with the income that the company generates. So for example, let's visualize from Apple perspective. Right now, the stock is trading at $218.98. And as we calculated before, the EPS is 6.16. What this means is that if you were to buy one share of Apple stock, you would be paying 35.55 times the EPS that the company generates. The higher of a multiple that you pay for that particular stock, the more expensive that stock technically is to buy, and the opposite also applies. Now, something critical to keep in mind is that very high quality businesses and very high quality stocks usually tend to have higher prices than lower quality stocks. Now you know the most important things about the EPS. If you've enjoyed this video, make sure to subscribe to the channel, and I'll see you in the next one.